By now, we are almost at the end of our strategic planning process. We have come up with our strategy. We have formulated the strategy in a strategy paper. We have developed some high-level initiatives and also some targets and KPIs for those initiatives. Today, we are bringing it all together in a financial plan and budget. Now, unfortunately, this step in the process is also the step that is quite tedious and that many students are struggling with, and also many newcomers to the strategic planning process. So I would like to spend some time on it, and I want to make it as practical as possible by sharing the approach that I have been taking in my past experience for budgeting. But as usual, we start off with a definition. So budgeting, or building a budget, is an estimation of revenue and expenses over a specific future period of time, and is usually compiled and reevaluated on a periodic basis. So we look at the revenues, the expenses, and we plan this for the upcoming period, normally the next year or the next 5 years or 3 years. And every year this process is repeated and the budget is reevaluated. Now, just to share how this fits into our planning cycle that we discussed in one of the previous sessions. So it pops up here a couple of times. Normally in the finalization of the strategic plan, there is also a budgeting step. That is the first draft. And then after the presentation to the board of directors, there's a second step, which requires usually a revision or some additional inputs into the financial plan and budget, as well as into the strategic plan. And in the end, which is typically the period around beginning of December, we have a final strategic plan and a final budget, and that becomes then the plan for the next year or for the next 3 years or the next 5 years. Now, what are the objectives of budgeting? Why do we have to do this? Why is this so important? First, the budget translates the management's operating plans for the upcoming periods, for the next couple of years, into quantitative terms, so into financial terms. That's very important. The second step is, once this quantification has happened, it allows management to allocate and to control the company's resources according to the plan. And ideally, if we control it well and if we allocate it well, we can achieve our objectives. The third objective is that we can predict cash flows by forecasting the revenues, expenses, and the capital expenditure. And so we can plan our cash in future periods. The fourth objective is to coordinate all the financial activities across all parts of the company. So that means also to coordinate financial plans across department and to manage departments in each area. And the final objective is to ensure that the strategic plans are actually financially feasible and that we can achieve all our objectives with the financial resources that we have to our disposal. Now, the approach that I would like to introduce here is a 7-step approach to budgeting. And as I said, this is the approach that I have been applying in the past couple of years in real life, in my day job. So first, we start with a historic baseline, and we use revenues for that baseline. And then we extrapolate, use economic industry indicators to get a baseline revenue forecast for the next couple of years. And from this revenue forecast, we can then, in a third step, build the baseline P&L, so fill all the other lines of the profit and loss statement. And that gives us a baseline. Step 1 to 3 are kind of the first steps in the budgeting process. Then we come to the second phase, which is to translate our strategic plan into financials and include it in the budget. And these are steps 4, 5, and 6. So in step 4, we basically build business cases for each of our strategic projects. In the next step, we map these on a timeline and identify which spend, which revenue, which benefit, which cost comes at what point in time. And then we bring it all together and create a first draft of the budget. So these are steps number 4, 5, and 6. Once we have all of this, we have a first draft, and then we need to check whether this first draft actually meets our objectives that we have set in our long-term vision. And that's what I call a gap analysis. So we look at our first draft budget and our long-term vision and our plan and see if there are any gaps. If there are any gaps, then we have to revise. We have to come up with additional initiatives and come up with a new plan or additional plans. So now let's get into the details and let's get technical. So the first step is to start with a historic baseline revenue. And as an example, and this is purely a hypothetical example here, I have taken TF Mama, the noodle manufacturer here in Thailand. And I started off with the revenues that I found in the annual reports. So 2017 to 2021. Now for 2021, I don't have the complete fourth quarter yet. I have only 3 quarters, so 9 months available, and I had to forecast or extrapolate the remaining 3 months. And that's why this is shown here as 9 plus 3. So 9 month actuals and 3 month forecast. So what we can see here is the revenues have been growing on average with 2.8% per year. That's the CAGR, or the compound annual growth rate. And we have some ups and downs, and obviously in 2020 because of the COVID crisis a little bit lower compared to 2019. But then in 2021 we expect to recover that basically fully. So that's the baseline revenue for our company. Now in a second step, what we try to do is we try to extrapolate and build a baseline revenue forecast. So let me explain how I did this here. And I did this very simplified. There's more complicated ways of doing this, more sophisticated ways. But basically we take the first part that you have already seen, the years 2017 to 2021, so the past 5 years basically, including the current one, as a base. And we see here again the 2.8% CAGR, compound annual growth rate. And then I looked at what has happened in the past 4 to 5 years in terms of economic indicators. And I just took, for simplification here, inflation per year and food industry trends. And I looked at were there any new competitors coming in that would have had a major impact, or any other factors that could have had a major impact on our budget and plan in the past 5 years. So what I found is the average inflation in Thailand during the past 5 years or so was about 0.5%, 0.49% to be exact. And the food industry, which TF Mama is a player in, grew by about 2.0%, so 2.0%. Now, what you can notice here is that TF Mama outperformed the food industry and the inflation over the past 5 years. So if we add the two together, TF Mama outperformed by about 12% per year. Now, if I look at the forecast, and again, these are economic indicators or industry indicators that I can get from reports here from Statista or from Euromonitor, I see a forecast inflation of 1.48%, so inflation slightly increases. And the food industry trend on the other side declines slightly. So it still grows, but it grows by 0.6%, so slower than the 2% that we have seen in the past couple of years. So if I apply the same kind of performance that TF Mama had in the past and apply this to those new indicators, then I come up with a growth rate of about 2.3%. And then I have applied this growth rate over the next couple of years, and I have just extrapolated and grew the revenues by that amount. So basically the idea here is, if we don't do anything, if we don't change anything, if we don't react, just based on the inflation and that we can pass on to the consumers, and the overall food industry trend, we should see a growth rate in revenues of about 2.3%. That is what I have modeled out here. Again, this is strongly simplified. There are much more sophisticated forecast modeling approaches that can be applied. But for our purpose here, this is enough. Then, once I have the forecast revenues, I can build the rest of the profit and loss statement. And you see here on the right side, I have made some assumptions. So I started off with a sales forecast as per the previous page. For other income, I just assumed that other income will increase with inflation. So I built that over the years 2022 to 2026 based on the inflation forecast. And then I made assumptions for other lines. For example, cost of sales. We see right now that we have a raw material squeeze around the globe. So I believe that in the next 2 years, this difficulty in getting raw materials will continue. The supply chain difficulties will continue. And therefore, we are likely seeing a cost increase of about 10% in just those 2 years. And after that, the global supply chains will catch up and the raw material cost will come down again to previous levels. But at least for 2022 and 2023, I have to assume that the raw material costs are increasing. Now, selling expenses, I just assume that I can maintain this as percent of sales. And administrative expenses, which is basically our back office, I assume that we see about 4% salary increase per year, which is kind of in line with what is happening in Thailand at this point in time. So 4% increase of salaries per year. So I applied this over the next 5 years. For other components of the P&L, I just assume that I can maintain it as percent of sales. And for corporate income tax, I assumed a corporate income tax of 20%. So all the lines add up, and that gives us a baseline P&L. And if I go to the next page, you see how this P&L plays out visualized. So the first part, the upper part of the graph we have already seen is the revenues. And then I just visualized the net profit as well, put it in a graph. And there you see already that we will have some challenges because compared to the year 2021, which sees a net profit forecast of about 5 billion Thai baht, 5,000 million Thai baht, we see a big drop in 2022 because of the cost increase, both personnel costs as well as raw material costs. And that, of course, hurts the profit. And the profit will recover after those 2 years, but it will not go back to previous levels or pre-COVID levels. So there is definitely something that we have to do. But again, this assumes this is the baseline. If we don't take any strategic action, if we don't do anything differently compared to what we are currently already doing. So with this, we have a baseline. That's the starting point. Now what we have to do is we have to add on top our strategic plan and the impact of our strategic plan. And here it becomes interesting. So in step number 4, what we have to do is we have to build business cases for each of our strategic initiatives. We talked a little bit about this already in previous sessions, but we basically have to translate our strategy, our strategic idea, our strategic project or initiative into a business case. And I've used a template here that I like to use for business cases in the company that I work in. And it's a very simple model and would like to share like how this works. So first, I have to assume or have to estimate what the CapEx is. And that is number 1 here in the chart. I try to find out what I have to invest in terms of capital expenditure. And what I took here is a energy savings case. So an investment in new chillers or air conditioning units or something like this in a factory. And here in this case, the number 52.4, that's the investment that is required. And in the second step, I have to enter the depreciation period. So this depends on accounting rules, internal standards, as well as the country's accounting rules. And these kind of chillers, air conditioning units, and they are depreciated over a period of 10 years, which is their useful life, the assumed useful life. So this 52.4 million baht have to be depreciated over 10 years. Then the third step is to estimate the benefits of this initiative. So for example, here installing new chillers, new air conditioning units. It can be extra revenues that are created, can be cost savings like in this case, or any other benefits that might be generated by the project itself. Then in step number 4, we have to calculate the depreciation cost. So in this case, it is basically the 52.4 million divided by 10 over 10 years. So that's 5.24 million each year. And the last step here is to calculate the corporate income tax impact from the benefit that we get. So of course, we have higher savings. Therefore, we also need to pay higher tax, which we have to deduct here from the net savings. So once we have this, we can then look at the overall business case. So we see here the cash flows. We see 52.4 million expenditure in year 1. That's the CapEx, the capital expenditure required. And then we see here savings coming in, as well as a deduction of income tax, which takes away from the savings, which gives us our annual cash flows. And then I can discount those cash flows at the cost of capital. In this case, I assumed 8% cost of capital, which depends on the company and on the industry that you are in. But for this case, I assumed just 8%. And that gives me annual discounted cash flows. In the lower part of the chart, I have mapped them out in a graph. And from here, I can already see that the business case is positive. So I will have a positive net present value of about 31.3 million from this initiative of installing new chillers, new air conditioning units. And this means that we have a payback, break-even point for this initiative in year 6, to be exact, after 5 years and 6 months, which we see here in the chart. It happens basically in the middle of year 6. Now, I have many of these kind of initiatives in my strategy paper. So now I have to map these out and see when are they happening. So when are the CapEx outflows happening? These are here marked in the red triangle. And what is the project implementation period during which I work on the project, but nothing really has happened yet in terms of benefits. And then when do I get the benefits from the cash outlay that I have? And you see here that for some initiatives, there might be a big CapEx required, and we see the benefits only 1 or sometimes even 2 periods later. And other initiatives like Project 4 here, the energy savings that we talked about in the factory, we will see the impact basically immediately, or at least in the same year, in the same period, and that we have the CapEx outlay. So finally, we bring it all together. And that is the last 2 steps. So we take the baseline, which you see here on the top left, the baseline P&L, and add to this baseline P&L all the business cases, the various business cases that we have come up with. And that gives us a first draft of the budget. And I have laid this out here. So this is how it can look like visualized. We have the baseline here, or the base case in red. And then each of the projects is an add-on, both in terms of revenues. Now, please note that not every of those projects has a revenue impact. but every project has at least a net profit impact. Like the cost savings initiatives, for example, would not have a revenue impact, so we wouldn't see them in the first chart, but we would see the impact in the second chart. And then in the third chart here on the bottom, the third graph, is the CapEx outlay over the next couple of years. So we see that this is not equally distributed. A heavy CapEx outlay will happen in the year 2022. And then again, a very big amount is needed in the year 2025. So that's when we have planned for a major acquisition. And that's why there's this big CapEx outlay. Now we are basically done with the first draft of the budget, but we see already from the graph that we do have a challenge. So first of all, what we see is that previously the net profit was actually declining over the next 5-year period. And this one we have already turned around. So it's already increasing by 3.3% per year, which is positive. However, we see a big gap in the next 2 years. And of course, we talked about it already earlier on. This is because we have a cost increase in those years from supply chain costs as well as personnel expenses that we can expect. So that hurts our profitability and we see a gap here. And that is a challenge. So probably management will not accept this kind of drop. Obviously, shareholders also will not accept this kind of drop. So we need additional initiatives to fill this gap. And the second thing that we can notice here is that we have a high CapEx, very high. It's almost as high as our net profit for the year. So this probably requires additional financing. So we need to come up with a plan of how we finance this additional CapEx, which happens in the year 2025. Now it's a few years to go, but as we are writing our strategic plan for the next 5 years, we need to include the financing for this CapEx in the plan. And this happens very often that you come up with the first draft of the budget and realize that there are gaps and that we have to go back to the drawing table and come up with new plans, additional plans that fill those gaps. And that's what we would do here. After we do a number of iterations, then we would come up with our final budget. So that's basically it. These are the 7 steps of how we get to a budget and financial plan, and how we can do our resource planning for the years to come to meet our strategic objectives and to be in line with our budget. Now, I showed you one approach, and that is my approach, the approach that I have been taking over the past couple of years when building a budget. I would like to at least share with you a few alternative approaches of how a budget can be built. So there are 5 types that I want to share with you. The first type is incremental budgeting. Now, we have done a little bit of this already in what I have shown you. We have actually started out with that. Incremental budgeting basically means that we use the past performance and we make small changes to that past performance. So we do just some tweaks here and there. We adjust what has been there in the past couple of years, and we basically just adjust the existing budget with some increments to reflect the growth or decline of the company based on industry trends. So that's called incremental budgeting. Another approach is to look at it from the other way. Look at it from the end goal. For example, if you want to achieve a certain valuation or a certain sales number, and then we work it backwards and say, okay, what does it really take to get there? This approach we would have taken in our iteration. Remember that we paused and said, okay, there's a gap in the next 2 years, so we need to do something to fill those. So again, this would be activity-based budgeting. So in the second iteration, we would move to that approach and we would look at how can we achieve our target for 2022 and 2023 that our shareholders expect. Another approach is the value proposition budgeting approach. And that looks at each line one by one and asks for each line, what is the value that this line creates to the customer, to our staff, to stakeholders, shareholders, to the business overall. So basically, each line item in the budget, each profit and loss statement line needs to be justified. And anything that does not bring value is basically cut or reduced, and things that bring a lot of value are then increased and try to maximize the budget in those areas that deliver strong results. So that's value proposition budgeting. Approach number 4 is probably the most radical approach, which is zero-based budgeting. So compared to the incremental approach that we had before, and also compared to the value proposition approach, zero-based budgeting assumes that every business unit, every part of the business has zero budget and needs to justify every single spend, every single line item based on the objectives that the business unit wants to achieve. So basically that means that every year we would build the budget again from zero, from a blank sheet of paper, and we would build it in a way that would justify why we need money to invest, why we need money to spend here and there, and would basically look at our business completely fresh every single year. Now, this is a lot of effort, of course, a very radical approach, but one that has become increasingly popular, especially as we have crisis in the past couple of years, especially with COVID. This approach can help to look at the business with completely different set of eyes from a completely fresh perspective, and typically results in very significant savings because things that have little value are just cut out, and some things that have been spent on for the past couple of years are just basically being eliminated or stopped spending on those items. Now, all of these approaches are called static approaches to budgeting. Static because we assume that we come up with a budget for the next couple of years, and this is basically it. That's the budget. That's the amount of money that management can work with, and that becomes the North Star, the orientation point for all the stakeholders, for shareholders, for staff, for management overall in managing the company. Now, there are also methods that are called flexible budgeting methods because they can be adjusted, or they allow the budget to be adjusted based on circumstances. So one, for example, is cash flow budgeting. So here we assume that we have certain lines of credit, certain cash flows that come in and out of the business. And if those cash flows change, then the budget will also change accordingly. This is quite similar to the surplus budgeting. So here we assume that we might not have enough money and enough budget for some of the initiatives that we want to do, for example, an acquisition, but we might be surprised. Maybe we have some unexpected surplus coming in, some unexpected savings, some windfall basically happening in the industry, and a competitor exiting, for example, and we end up with a big surplus at some point. And in the surplus budgeting method, we would just say, okay, once we have that surplus, then we make the acquisition. Or once we have enough money in cash, then we buy this machine. So it's quite a flexible approach, which can be used, for example, as a top up to an existing budget, or it can also be used completely standalone. So these were the basic budgeting approaches and a short introduction to budgeting and financial planning. Again, it was a little bit technical, and I tried to keep it as practical as possible, not very academic. I hope it was still useful, and this leads us to the end of this session, and then we will, in the next session, complete our strategic planning process with the organization structure and organizational planning.